Hi, good friends. So welcome once again. So we looked at the audit evidence, okay? As part of gathering the audit evidence, we will now want to look at how do I go about it, okay? So remember we ended looking at the control testing and substantive testing. So we want to move on to audit testing, which will cover both legs, okay? And then sampling techniques, and then analytical reviews. Most audit companies will usually have their own software or tools which they use for this testing. So it shouldn't be something that you need to worry your head about and trying to design something. Of course, when you get into the workplace, you can always improvise and then find some more innovative ways. Anyone who knows how to use an Excel will be a very good analytical person. Let me put it that way. And what we know is that most or every accounting software developed, every analytical software developed is built upon Excel. So you should be able to know how to use Excel, at least basic to intermediate. Depending on how fast I go or how detailed I go slowly, I may split this section also into two parts. Okay, but let's see how it goes. I'm just monitoring my time. Okay, so we're looking at audit testing. There's an appendix at the end. I will usually leave that one for you to review later. All right, so let's go full screen, audit testing, sampling. Great. So audit testing, sampling, we want to see the principle of evaluation of risk of material error or misstatement going undetected. Relationship between audit sampling, audit risk, and materiality. We will come back to some of these concepts again. Like I said, the whole module is cyclical. Today you hear a certain word, materiality. Don't be worried. What does it mean? We'll get to the main heart of materiality. Today you hear audit risk. You hear inherent risk. You hear control risk. You hear detection risk. It's actually something you will go and we'll meet somewhere again in detail, all right? Okay, and then we look at compliance, nature of compliance and substantive testing. I will not go much into this, but I'll look at it later. And then techniques of audit sampling, and then we'll look at the use of sampling as a valid audit technique and look at its limitations, and then of course we'll look at analytical review procedures. Now listen, it is a summary of the slides, okay, chapter 12. I would ask you to spend time and delve deeper into it. Okay, pick the SECA text as well and look at it. All right. Like we said earlier, we need to gather evidence to support our work, to support the conclusions, opinions that we issue. Our evidence must be of the right quantity, sufficient, and it must be appropriate in that it will be reliable and relevant for the work we're doing. Now, the quantity we gather will be determined by our estimate of audit risk. What do we mean by audit risk? Audit risk is the risk, let me put it in a layman's language, is the risk that the auditor's opinion is wrong. Okay, so the auditor ends up giving a clean opinion to the client that everything is true and fair, it's okay. But in reality, they did a mistake. The opinion shouldn't have been that way, okay? So that's audit risk. Now, audit risk is usually a function of three items. One we call the inherent risk. Okay, you can see it there. Inherent risk is the risk, let me again put it in a layman's language. It is the risk inherent in the organization. Okay, so there are organizational culture, the activities of the organization, the environment, the nature of the business that they do. These are inherent factors prevailing in the organization. Now, the risk that these inherent factors could lead to the risk of material misstatement, error, or fraud, okay? Control risk simply means that there are controls in place, internal control systems in place, but they may not be robust enough to detect risk of error or misstatement or fraud. Or the controls are there, but they are not being implemented to the letter. People override it. Okay, so that's control risk. And then we have one more thing, which is a third function of audit risk. It's called the detection risk. omit it again. I'll mention it again. Detection risk is that the auditor's procedures of testing and analytics and reviews and inquiries, all the testing he did was not sufficient enough to detect the risk of error or material misstatements. Okay, so the names, the definition of the terms are inherent in the names, are within the names. Inherent risk, inherent nature of the organization. Control risk, control environment, control internal control systems, not detecting the risk of misstatement. And all right, and then detection risk. So the quantity we also gather will be determined by the approach we use as an organization. Okay, do we want to rely more on internal controls, test more of internal controls, or we want to engage in a good amount of substantive testing? Okay, so that one also will determine the quantity that we have to select. How do we obtain evidence? Okay, how do we obtain evidence? So inquiry, talk to management, ask them questions. Okay, so inquiry is very important. Inspection is also key. Okay, so you look at inspecting source documents. Okay, vouch them. Observation. So you also observe. It's also one of the key things. What is happening? How is the process working? Maybe observe inventory count. Observe cash count. Okay. Confirmation, where we sometimes can confirm within the organization, but usually confirmation deals with going to third parties. So sending an independent bank confirmation letter to the bankers to confirm the balances the client has reported, or people owe the company debtors, receivables, sending confirmation letters to them. Even payables confirmation also reoccurs. And then we have recalculation and reperformance. I would say these are computational, okay? So conduct some calculations, some ratio analysis, some cash checking, okay? Reperform a walkthrough test, okay? So they said their sales system is robust, okay? So go through, reperform everything. Sometimes you have to prepare a real bank reconciliation statement to check what they have done is correct. And then analytical reviews, okay? So analytical review procedures normally we'll deal with that at the very last end. So you take in financial statements. It could be also non-financial statements. You conduct some form of relationship check between the financials of this year and that of last year and see the change, okay? So you can do a horizontal analysis. You are accountant, so you understand what I mean when I say horizontal analysis of the financial statement. So where you look at year-on-year changes. You can also conduct a vertical analysis where you take a transaction balance against the other, so sales to the gross profits, okay, and look at the changes. And of course, you can also link this one to non-financial parameters. Normally, we do analytical reviews as a planning tool, as part of the planning. And then we send the questions out to the client so that he will get the answers for us before we go to the field, okay? All right. Making inquiry alone is not enough. You must always corroborate it with additional information. So just speaking to management and they telling you that, oh yeah, that is the amount, that's how we got it, it's not enough. You must look for another confirmation to corroborate your evidence, okay, to support your evidence, okay? So it's very key. All right, this is what I've gone through in terms of inquiry, ask questions, inspection, observation, if laid out, observe to see if laid out procedures are followed, calculations, computations, analytical procedures. Okay, I've done this. Now, audit sampling. ISA 530 defines audit sampling in the sense that we are applying some audit procedures to not all the population, just a few, okay? Less than 100% of the items in the population, okay? But whenever we are selecting, we are applying our audit procedures to this selection, we must make sure that every item selected actually had an equal chance of being selected, no bias, okay? So that when we draw conclusion, the conclusion will reflect the real picture of the population, okay? It should be representative of the population. So it is more of a random sampling definition cited over there, okay? We don't want to see any biasness there. Now, when designing these audit procedures for the sampling, ISA 530 tells us that we should consider the purpose of the audit procedure, the features of the population from which we are selecting the sample. And again, we should select a sample size which is sufficient enough to reduce the sampling risk to an acceptably low level. Another terminology has come up, sampling risk. Sampling risk is the risk that the sample you have selected is not representative of the population. Therefore, any conclusion you draw with the sample that you have selected and which you have tested may not be right. Okay, so sampling risk, that's what it means. Okay. Why do we use sampling? Because we cannot test everything. Take HSBC. Let us leave HSBC. Take which supermarket? Tesco. Look at the transactions that occur at one branch of Tesco Extra in a day, in a week. And assuming you're going to audit that particular client, you cannot audit everything. They have millions and millions of transactions within the year. So because we cannot do everything, if we want to do everything, it doesn't make sense. It's not cost effective. We sample, we choose some of them, okay? Now, there are situations where the transactions are few, just few. If they are few, the population is few, you must do everything. Like check and cut-off procedures, you do everything. If you're going to deal with a company that deals in building houses, how many houses can they build in a year? Okay, if you have to count the houses, you can count everything. You can count everything. So where the population is few, you can do everything. Four rules when sampling. 4 rules. Make sure every item you select had an equal chance of being selected. No biasness, okay? The sample must be selected from within the population, not outside of the population. They must be homogeneous. They should have the same features. So if I'm checking sales invoices, I'm picking only sales invoices to test. If I'm dealing with payroll, I'm dealing with only payroll items, okay? The results cannot be used to assess a different population, okay? So you tested raw materials. You cannot use raw material sample to draw conclusions on finished goods or work in progress, okay? The reason why we are saying this is that, listen, if there are two terms, we call one interpolation and we call one extrapolation. Interpolation is always reliable. What does it mean? It means that you are picking the sample, okay, or you are making a projection based on the scope of the population. So you pick a sample, and after you've done your analysis, you use that one to project what will happen in the future. But whatever projection you are making is within the scope of the population. Interpolation, quite reliable. Extrapolation, you pick an item which is outside the scope of the population and you make a projection. It can be true, but it may not be reliable because it's outside the scope, okay? So make sure they are within the same population. All right. So what we are doing here as an auditor is that we want to reduce our detection risk to a very low level. The risk that our procedures will not detect any error of misstatement or fraud. We want to reduce that risk to a very low level. We cannot eliminate the detection risk totally, but we can reduce it to a very lower level, okay? Now, if inherent risk and control risk are high, the risk that pertains to the nature of the business, the activities that the organization does is high. The risk that the control system, the control environment are not strong enough to detect any risk of fraud or misstatements. If this risk is high, then we must ensure that our detection risk is very low. How do we ensure that our detection risk is low? Increase the sample size. It makes a lot of sense, okay? The more sample, the propensity, the higher the propensity that you can detect something, okay? So in terms of substantive testing, increase your sample size. Sampling risk, I mentioned it, okay? So the risk that the sample you have selected does not really reflect the entire population, okay? It's not representative. So if you use that work you have done on that sample to draw conclusions, it will be different from what would have happened if you have taken a different sample from that population. So sampling risk, we want it to be slower. How does sampling risk drop to become very low? You choose more size, more sample size, okay? So 2 things you are realizing here. Detection risk can be low when you increase your sample size. Sampling risk can be low when you increase your sample size, okay? Now, when is sampling not appropriate? When the transaction balances are material, very huge, friends, it doesn't make sense for you to sample some of them. Do everything. If the population is too small, do everything. You can do everything quickly, okay? If the data is very sensitive, do everything so that you can shield yourself from any future mishap, okay? For example, when I was with KPMG, I was assigned, I remember working on Standard Chartered Bank. I was assigned to work on directors' emoluments. Sensitive area, you don't have to select some. Besides, there are very few. How many non-executive directors and directors? You do everything. I have to do everything, okay? Again, if the population, the detail of the population, the constituents of the population do not have the same features and characteristics, do everything. Do everything, okay? So these are situations when you have sampling doesn't apply, you have to do everything. When do we use a sampling approach? So again, assess the level of inherent risk, assess the level of control risk before you decide on a sampling approach, okay? Now, your sampling approach will be affected by the size of the client, whether it is a multinational or small, medium sized, the type of accounting system they have, okay, the number of transactions within, and past experience of the client, okay, so on and so forth, okay. If you're a new client, if you are a new auditor to the client, you may want to consider the sample size that you choose, okay. But if you are an existing auditor and you already know the nature of the transactions and their systems, you may want to reduce your sample size or the approach that you use, okay. Sample selection must be random. We've said this, representative of the population, protective in that it will reduce our audit risks to a very low level, and it must be unpredictable to the client. If the client is able to detect the method you are going to use, the sample you are going to select, they can cook the books. They can cook the books, okay? Consider the objectives you want to achieve. What assertions do you want to test? Okay, what management assertions do you want to verify before you select the sample? Again, make sure that the population is homogeneous. They have the same nature, characteristics, features, okay? And again, right from the onset, decide the sampling unit that you're going to use, okay? Am I going to use an invoice or a pound, a currency amount? Okay, that's what you should start. Let's pick some quick questions on sample selection once again. Like I said right at the start, determine what will constitute error or deviation, okay? If there's no authorization, there's no purchase order, there's no three-way match, then I think this will constitute an error or deviation, okay? There's no NCR, non-carbon receipts, you can just set that one off. Set and assure a level of assurance required, a confidence level, okay? Normally, it is advised that your confidence level should fall within the three main standards, the 90% confidence level, 95% confidence level, or 99% confidence level. But as an auditor, myself, I would advise you go for the top two, 99 and 95, so that your chance of making an error will be what? Very low. Once again, the higher your confidence level, the lower the chance of making an error, or the lower the margin of error. Again, if you have a higher sample size and a higher confidence level, what do you think will happen? Your chance of making an error will be very low, okay? Some people will try to say, if I'm having a 99% confidence level, my sample size could reduce. No worries, that's okay, because your confidence level is so high. So set a level of assurance, okay? Again, determine the level of tolerable misstatement. So a threshold must be set that, well, if the difference I get is plus minus this amount, I'll accept it. It's nothing. It doesn't affect the accounts too much, okay? Unless you think it has to do with fraud. Even that one, some people will overlook it. 500 pounds fraud for the whole year. They may talk to the person, but not to pursue it further, okay? So set your tolerable rate of deviation. It is always set plus minus something, okay? So this rate of deviation from prescribed internal control procedures. Now, is your sample intended to confirm a specific internal control system? Is it intended to confirm specific transactions and balances? The method you are using, is it appropriate? Are you using random sampling, stratified sampling, block sampling? Okay, is it ideal for what you are testing? Okay, your sample size, when you are considering your sample size, look at the population size. That will tell you how many you should pick. Look at the materiality of the items. okay, of the population in terms of the overall opinion and of the sample in relation to the population. So each item, what is the amount attached to it? What is the figure? Is the material significant? Is it something you can wink over and you don't think will create any problem? The lower the materiality limit, the greater the sample size. The lower the materiality limit, the greater the sample size, okay? Degree of precision also sets right precision. So your tolerable level that you think you want to accept, please set it right. So this will be plus minus 1%, plus minus 10%. You want to write it off, okay? There are always tools that is used. So this is where materiality comes in, okay? All these precision level, tolerable rate of deviation, and tolerable amount of misstatement is what we term materiality. We'll take a whole session on materiality. So I'll leave it here for you. I'll leave it as we proceed. What statistical sampling or judgment sampling procedure should we use? Sampling is in two parts. Okay, sampling is in two parts. Or basis, let me say approaches of sampling two. We have statistical and non-statistical. Okay, statistical is where we're using scientific methods. Okay, in research we call it a positivist approach. Okay, where what I see, if I don't see, it doesn't exist. If I don't hear, there's no sound. If I can't smell it, then it doesn't really have a scent, okay? If I can't taste it, it has no taste, okay? So we want to use the senses to confirm that it exists, it occurred, okay? We have rights and obligations over it, okay? That's statistical. Judgmental, you use your intuition, okay? You use your intuition. So in these cases, whether judgmental or statistical, how many do you want to test? Which ones do you test? Which ones don't you test? Okay. So you can use your personal judgment, but be careful you don't bring in some bias. Statistical tools are good. Most audit firms, like I said, have their statistical tools that they use to run the show. Okay. Why? Because these statistical softwares that they use are reliable, they are scientific, precise, objective. The client cannot predict what will be selected. Okay. Whatever they select are representative. Of course, you put in parameters. So select between this to that amount. So you give a parameter. And of course, they will always select precisely what you want, okay? And you can always defend this in a court of law if anything should happen that, well, I use this software, the software is vouched, and I think I could use it, okay? So it's generally more acceptable to larger clients with large number of transactions than smaller clients. Smaller clients, if you can do everything, you do all. One of the statistical sampling methods is what we call stratified sampling. Stratified sampling deals with where you divide the items into layers, into strata, okay? Some call it strata, okay? So at this point, you want to say, what are the high value items? What are the low value items? What are the sensitive items? Which ones are not the sensitive items? So you want to break them down. Overseas transactions or overseas receivables, local purchases. So you break them down into strata, into particular categories based on features, okay? The idea is that we want to reduce the level of variation, okay? We want to reduce the level of variation between items within a population so that the auditor can direct attention to those areas which are of importance to him, okay? Areas I think will give me an error. That's where I'll focus on. Now, it has an effect, often has an effect of reducing the sample size, okay? For example, where auditors are concerned with overstatement of errors and consider that the largest monetary values or monetary errors are likely to occur in the largest individual items, they may wish to stratify the items by value, okay? It's a layer. Audit efforts will then be directed to these items which have high values. We'll take an example. So let's say the financial, we've picked some transactions, okay? All items with values above 1 million are 10, just 10 items. When we sum those 10 items up, they give us 36 million. It's just small, 10. Let's select all the 10 and test it. All items or transactions with values between 250,000 to 1 million are 150. Not too much, they are just a few. The overall value is 95 million. We choose 1/3, 50 items out of this. And of course, you would like to concentrate on the high value items. Now, items which have values of 50 to 250,000, there are 1,000 transactions. It's a lot. You cannot choose all. Of that 1,000 transactions, when you sum them up, it's 93 million, lower than the 150 items, which were between 250,000 to 1 million. So I just choose another 50. Okay, then I test overall. Out of the 1,160 items, I test how many? 110. Okay, so that's it. That's stratified. Then we have the popular one, random. Every item in the population has a chance of being selected, no bias. The sample then represents the population. It becomes representative. Okay, I should have ended here, but I think we can wrap this up in the next 5 minutes. So sample is representative. Sample is selected from a number of random numbers. Okay, you could use a computer program. If there's a software at the organization, the software will always work this one out for you. Okay. Excel is also having that function for random selection. So in terms of random selection, like I said, every item has a chance of being selected, no bias on the part of the auditor. No predictability. You can't predict. Even you, the auditor, you cannot predict. Okay. So it helps you to check items with some kind of positive mindset, scientific mindset. Now, we also have random systematic sampling. Here, you divide the population by the sample size. I need 20 samples. Population is 1,000. You divide the 1,000 by 20 samples. You get a certain figure. Okay. So let's say, for example, the item is 600 items. After you finished your division of the total sample that you need over the population, you realize that it is 600. The first item you choose, okay, the items are 600, the sample size is 60. The first item you choose, okay, after you've done your calculation, dividing 600 population by sample size of 50 is 12, okay, 12. So 12 becomes the indicator. Now, the first item you choose, you will use random sampling. A computer-generated system will choose the first item for you. After you've chosen the first item, let's say the first item fell on the 15th number. Now, before you start with this, you have to rearrange the items in a logical sequence from the lowest to the highest, or in an ascending order. So the first item, you use a statistical tool, a random sample, it will choose the first item for you. So let's say the first item is the 15th item, 15th number, okay? Then from the 15th, the next item will be the 12th, because you divided 600 population by 50, you got 12. So from 15, the next item will be the 12th item after the 15. So 15 plus 12, 27th item is what you pick. The next item will be the 27th plus 12, 39. Okay, then that's how you choose. This systematic. Continue picking systematic, the 12th item after you've chosen the first random item. And then we have what we call value-weighted selection, sometimes called the monetary unit sampling, okay? So here we look at currency, value, unit, rather than a number, the item. It is also like a systematic, okay? But here we look at the value, okay? So for example, we're taking £1 is selected out of the first 2,000. And thereafter, each 2,005 pound is selected. Each 2,000 pound is selected, okay? So the item includes that pound for selection, for examination, high value items. And we normally call it the MUS, okay? It's also called the MUS. And then we have block sampling, put them in blocks. So I'm going to select all sales which occurred within the week after lockdown. Okay, so that particular week. So you select them and then you test, okay? It can achieve some good cost savings in terms of audit time. The disadvantage is that what if the week you've selected, there was not much transactions? It means you will just be shortchanging yourself, not the client, because at the end of the day, you are focusing on some few when there is more somewhere you should have focused on, okay? So they may not be typical of the population. They may not represent the population. So evaluation of results, after you've done your analysis and you get some error, what do you do? Okay, so let's say out of a population of 20,000 pounds, you realize that for the first sample of 5,000, which you vouched, which you tested, there was a deviation of 84. 84. Divide the 84, express the 84 as a percentage of the sample. So 84 divided by 5,000 give you like 0.00168. Okay. And then you multiply it by the total population and check. Okay. So you express the 84 as a percentage of the 5,000 sample, which you have tested, and then apply it to the population. You get 336. If this error is below the tolerable error you have set at the beginning, remember the rules we started that before you start, set a tolerable error or a tolerable rate. If it is within, it's okay, go on. But if it is outside of that, then you have to do more testing. You must either amend the accounts, okay, or ask them to adjust the accounts, okay. So normally when we set those tolerable margins, okay, plus minus, and we realize that the deviation we have had is within, no worries, no adjustment. But if it is outside of it, you want to do more testing to be sure whether what you are doing is right, or you want to ask them to pass adjustments, okay. We're wrapping up. Analytical reviews, like I said, it is where we understudy ISA 520. We understudy the relationship between the elements of the financial information so that we can predict a particular trend based on the organization's experience. It can be between financials and financials. It can be between financials and non-financials, okay? It can be on horizontal or vertical of the financial analysis, okay? It can even include financial ratio analysis, okay? Then ask yourself, why is the payable days increasing when we are not purchasing more? Why? Okay, why is the receivable days reducing when we are selling more, whilst cash remains the same? Okay, so you ask yourself questions. So it is a form of substantive testing. We normally do it at the planning stage, okay? There are two things you normally find in a typical audit engagement: the initial planning analytics, and then the final planning final analytics, okay? To reconcile the differences which come up, okay? They give you a sense of what you should go and do on the field. Normally, when you do the planning analytics, the analytical reviews, you get questions, you raise, you send it to the client. The client will have to populate answers and prepare it for you. When you come, you have to explain it, okay? So it can also provide proof in total of the accuracy and reliability of the financial statement during the final year audit, okay? 5 considerations, then we wrap up. So analysis of, you are analyzing relationships and analytical procedures. You're comparing actual to predicted. You can compare year on year, current year to previous year. You can compare your performance to a competitor's, if it's allowed, if you have the information. Or you can even compare your performance to the industry averages, okay? If there are any variations, investigate it and ask for explanations for these variations, okay? And evaluate any results which they give to you. Corroborate the evidences, okay? Corroborate the evidences, okay? There are limitations to analytical reviews. There must be reliable data for comparison. Otherwise, you are just wasting your time. Consistency is not usually conclusive, okay? The fact that the changes are okay is not conclusive. There could be something hidden somewhere, okay? Good control procedures are usually necessary if we want to rely on analytical reviews. So if the internal control systems are not good enough, but the analytical reviews are quite beautiful, consistent, question yourself and question what is happening. Material items should not be tested using analytical reviews alone. Any items of a high value, significant figures, don't use analytical reviews alone. Seek another explanation, do some corroborative analysis, okay? I'm gonna leave it here. Everything else you see here are just appendices. I would like you to look at them, okay? Some sampling testing, okay? I'll leave it, and then this is an analytical review on horizontal analysis, and there's a vertical analysis, okay? So I'll leave it here. 3 questions you would want to look at. If we were to be having a case, a coursework, it would have been on analytical reviews, okay? It will be on analytical reviews and sampling testing. So for now, I would ask you to look at pages 200 and 201 of the core text. There are 3 questions there. And I've also highlighted 2 examination questions, very important to engage with them, okay? So friends, 37 minutes. That's good. Okay. All right, I leave it here. Okay, I leave it here. Like I said, if we were to be doing a coursework, it would be on analytical reviews. Back in Strathclyde, when I was teaching audit with one of the seasoned guys over there, that's what we do. And to date, I know that's what they do. They will give you analytical review questions for you to go and evaluate, and then write some good. It submerges you into the audit practice. You feel like you're already practicing an audit because you get a real case financial statement and you have to conduct an analytical review. Okay. Friends, I'll leave it here and I'll see you when I see you. Thank you and bye for now.